Thank you. Hello, my name is Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Alan House and Nathaniel Aikman. Today we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and finally answer your questions. Please note that this presentation will be available on our website at valueline.com and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The June employment report exceeded expectations. Indeed, the nation added an estimated 147,000 jobs last month, easily surpassing the consensus forecast of 110,000 and up modestly from the estimated 144,000 jobs created in May. The sanguine report also included a drop in the unemployment rate from 4.2% to 4.1%. In addition, the job openings and labor turnover survey, the JOLTS report, showed an increase in the number of job openings last month, which alleviated some concerns about a slackening labor market. The labor figures further reduced the possibility of an interest rate cut at the July Federal Open Market Committee, FOMC, meeting. That, along with the slight increase in the personal consumption expenditures price index in May and the Federal Reserve's concern about the impact of tariffs on the pace of price growth, likely pushes a rate reduction to at least the September FOMC meeting. Between the next two meetings, the Federal Reserve will hold its annual Jackson Hole Economic Policy Symposium in late August. Wall Street is still forecasting one or two reductions in the federal funds rate this year. The short-term benchmark interest rate, currently at 4.25% to 4.5%, is widely considered to be restrictive. Thus, with uncertainty about the impact on growth of the tempestuous global trade policies, we think the central bank will begin to bring the federal funds closer to the longer-run neutral rate, which is around 3%. Meanwhile, President Trump signed a comprehensive tax and policy bill into law on Independence Day. The legislation, which is estimated to add more than $3 trillion to the federal deficit over the next decade, also increases the ceiling on the national debt by $5 trillion. In the near term, the clarity of having a budget deal along with rollbacks in financial and energy regulations could potentially boost economic growth in the second half of this year. In conclusion, With the market still weighing the impact of a number of factors, including the new budget deal, tariffs, and the Federal Reserve's next monetary policy move, some volatility in the months ahead can't be ruled out. Given this backdrop, investors should maintain a diversified portfolio led by high-quality, large-cap stocks. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. To that end, we're constantly working to improve our offerings in order to ensure the best possible experience for our subscribers. Our latest innovation in that regard is the Value Line digital booklet, which offers our subscribers a new powerful tool to see the information we provide digitally in a faithful reproduction of its original printed context. To access the digital booklet, first head to the dashboard where I am already located and then click on the investment survey under traditional online access. From there, the digital booklets for both current and back issues can be accessed. Once the digital booklet is opened, navigation is as easy as flipping the page or alternately jumping to a specific bookmark using the sidebar, which is conveniently organized by industry. On top of our regular reports, Value Line provides additional daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. I will now show you how to access these reports. First, head to the dashboard. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. And due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now, let's look at the screener and our one stock to buy right now. For this, let's go first to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. And we'll go to the screening criteria steps. And the first filter we will use is the timeliness rank, and we're looking for a timeliness rank of 2 or better. The timeliness rank is used to predict the relative 6 to 12-month performance of stocks in the value line universe. The format is an easy-to-understand scale from 1 to 5, with 1 being the best performing issues on a relative basis. Most often, stock buyers will want to avoid ranked 4 or 5 stocks, while stocks ranked 1 or 2 are considered above average. Today, we're looking for stocks ranked 2 or better, and applying that filter, we're now down to 400 candidates. Our second filter is the 18-month target price range projection, and we're looking for an 18-month price target of 25% or better. And with that, we are focusing on the intermediate term. And with that filter applied, our list has now narrowed to 122 candidates. The third filter is a financial strength of at least A. We also want to focus on financially sound companies. Given the still somewhat volatile markets, we are going to emphasize stocks rated at least A for financial strength. By applying this screen, we've chipped away the list of prospects down to 27 candidates. And then finally, the fourth filter is going to be a total return above 20% over the past fiscal year. And after applying this screen, our list of prospects is down to 9. They are Applied Materials, Amphenol, Curtiss-Wright, KLA Corp, Lam Research, Meta Platforms, Microsoft, Netflix, and NVIDIA. You can make a case for any of our remaining candidates, which span a number of different sectors, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Netflix. Before I click on Netflix, please note that screens can be saved and revisited by utilizing the Create Save Screen button at the top. And let's go to our last full-page report. Netflix is a well-known entertainment company that has grown to have over 300 million global global subscribers. It still derives over 40% of revenue from the U.S. and looks to increase earnings per share by about 25% in 2025 thanks to price increases primarily. The implementation of ads has not hindered popularity either, and content continues to improve markedly as programs are increasingly tailored to individual markets. The valuation is admittedly high, but has always been at a premium to the market, and last week's earnings results were broadly in line with expectations, but like many companies reporting this earnings season, the stock has endured some modest profit taking. We think this is a good entry point for investors. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation. Now I will hand it off to Alan and Nate.
Thank you, Charlie. We have a few good questions that came in. The first one is, please discuss the PE ratio in more detail and how it can be useful for investing. Excuse me. The price earnings ratio, or PE, is the most widely used statistic in investing. If you are like most accomplished investors, you will not make a move without knowing the PE ratios of the companies whose stocks that are on your short list. In addition, you will regularly check the PE ratios of the companies whose shares you own. The PE ratio is a measure of a company's market value relative to its earnings. In the most basic sense, a PE ratio is the price of a company's stock at the close of the previous trading day divided by its share earnings. Value Line calculates the PE by dividing a stock's current price by an earnings figure that includes 6 months of past earnings and 6 months of projected future earnings. Let us say a company's share price is $40 and its earnings per share is $2. Its PE would then be 20, which is 40 divided by 2. If the company's earnings jump to $2.50 and its price remains at 40, then its PE would be lowered to 16, a more attractive scenario in this case. There is no right or wrong PE. Expect to pay a higher price and accept a higher PE for companies whose earnings are accelerating. The opposite holds true for companies whose earnings are flat or growing more slowly. If you believe that earnings are poised to take off before the if you believe that earnings are poised to take off before the market recognizes it and the company is maintaining its current PE ratio, you may want to buy now in anticipation of a future earnings jump. In fact, depending on your tolerance for risk, you might be willing to pay a relatively high price for a stock with low or even no earnings in anticipation that it will be a standout moneymaker in the future. On the other hand, if our analyst projects continuing profit growth for a company, but its PE is already high, you may want to wait for a pullback in price before committing funds so you do not have to pay more than you want based on the total return you anticipate. You will also find a trailing PE and a 10-year median PE in our data. The trailing PE does not consider future earnings. It divides the stock's previous trading day's closing price by the most recent 12 months of actual earnings. There's also a question that came in. How are dividend-paying stocks good in volatile markets? There are several reasons why they are good, especially in volatile markets. One is they offer a steady income stream. Even if the stock price swings wildly, dividend-paying stocks still provide regular income. That's like getting paid to weather out the storm, as they say. The income can cushion the blow during the most turbulent market downturns. Also, it's implied financial strength. Companies that consistently pay and even increase dividends usually have strong cash flows and solid balance sheets. That stability can be reassuring when other parts of the market are shaky. Also, lower volatility. Dividend-paying stocks, especially from big established companies, tend to be less volatile than non-dividend growth stocks. Investors often flock to them for safety, which helps to stabilize their prices. They also offer a total return advantage. In volatile markets, capital gains might be hard to come by. Dividends contribute to total return, which can make a big difference if shares prices are flat or declining. Finally, there's also reinvestment opportunity. If you're reinvesting dividends, you're essentially buying more shares during downturns when prices are lower, which can supercharge your returns when the market recovers. Thank you.
So I've got a couple of questions here. I've got one. Can you explain how a stock can be timely when its projected gain is small? And so what that is the timeliness rank and those 3 to 5 year projections are those are different measurements, and there's two primary differences between those. The first is with the timeliness rank, that's looking at the year ahead time frame. That's looking at the coming 12 months. Whereas the 3 to 5 year numbers are just that. It's 3 to 5 years out. So the time frame is different, but also the even more fundamental difference is that the timeliness rank is a relative measure. That's measuring relative price performance over that 12-month period. So if something's ranked 1 for timeliness, we're saying this is going to have a better price performance than most other stocks out there. But we're not saying what the absolute gain will be. We're just saying it's going to be better than all of these others. Whereas, with the 3 to 5 year numbers, that's an absolute projection. The numbers are the numbers. So they're different things. They measure different things. And so because of that, you can have a stock that's, very timely but has a small projected gain. You can have an untimely stock, but if you look to the absolute, 3 to 5 year performance, you actually have a huge gain there. So they're different things. And follow-up to that, how do we compute those 3 to 5 year projections? I can't get into too much detail there, but basically that's what we as the analysts do. We compute basically we compute our estimates for future earnings and revenues using a variety of methods, and then we crunch the numbers and arrive at our projections based on that. So the projections that you see there are based on those numbers that you see in that final 3 to 5 year column of the array. And so it's all statistically based. It's all based on exactly what we think this company is going to do in terms of its performance. I've got another question here asking if I can elaborate a little on what sort of the international picture looks like for Netflix. And yeah, I can do that. So right now with Netflix, right, huge name, obviously, and already pretty, solid penetration in a lot of the developed world. So a lot of the really big opportunity for Netflix right now is actually in emerging markets. And so just some areas there, like India, for example, you have an absolutely massive population. A lot of them are young. Um, very rapid rises in smartphone and internet usage. That's a theme that you're going to see with a lot of these countries where Netflix has a lot of opportunity is, just the degree of smartphone penetration. And in many cases, users are actually, mobile first users, which means that, that is their sort of first exposure to, computer technology, the internet is they're using smartphones. And then beyond that, India has an absolutely massive film culture. I mean, there's obviously Bollywood, which is, huge, famous, iconic, but there's also a bunch of smaller regional film industries within India. Like, for example, Tollywood, which is, the Telugu language cinema in southern India. There's all of this stuff. And that's good because there's not only, a lot of opportunity within the country for Netflix, but there's also a lot of crossover appeal internationally because the Indian diaspora is so huge and has a lot of demand for that content. So being present in India also helps them other places. Um, and finally, their international content in India. There's also demand for that because there's growing levels of English language proficiency within India. So you see this sort of very interesting sort of cycle there where the Indian language content, there's demand for that internationally. The international content, there's demand for that in India. And so it all just sort of works. There are challenges there. There's price sensitivity. The average revenue per user in India is low, and also because of that strong local film industry, there are also strong local streaming competitors that they're having to, fight with, but that's a really good opportunity for them. Some other ones, there's Africa, um, very similar profile in a lot of ways, lots of young population, um, within the urban middle class in some of these countries like Nigeria, South Africa, Kenya, strong English language proficiency. Nigeria also has a very large film industry. But once again, you have some financial challenges, low disposable income, and there are also infrastructure challenges in Africa, limited broadband access, and also there are some challenges with payment processing from African countries in some contexts. Latin America, that's another one. Again, you see the high smartphone penetration. You see these established entertainment markets. And once again, there are some economic challenges, but it still presents a very big opportunity there, in like Brazil, Mexico, Argentina, Southeast Asia. Again, very similar profile, and something unique there is streaming is actually often cheaper than cable in Southeast Asia. However, with that, we're talking, it's not, monolithic. We're talking about a lot of different, languages and markets and cultures. And there's also a lot of competition from like Chinese streaming platforms in that area as well. And then finally, one that's not so much a developing market anymore is within the Middle East, you have a population very wealthy, consumes a lot of content within certain, Middle Eastern countries like the UAE, Saudi Arabia, and in a lot of cases they're underserved. There's not a ton of original content in Arabic. But in that case, the challenges tend to be a bit more cultural and political in terms of, cultural sensitivities and censorship. But there's a lot of opportunity globally for Netflix, especially in emerging or underserved markets. All right. I'm not seeing any other questions I think we can get to today.
Okay, thank you, Nate. We'll hand it back to Aaron, our producer. Thank you.
Thank you, everyone, for joining. This concludes today's event. You may now disconnect your lines and have a great day.